Hi, Joseph. Good to see you.
Good to see you too. I had a really weird lighting thing going on first. I think I fixed it. Of course, my new neighbor's dog decided to immediately start talking.
Yeah. Oh, Kenneth's here. Welcome, Kenneth.
Thank you, Eunice.
How are you?
I'm all right.
We'll just give another minute for people to join and then we'll get started. Okay, I think we should get started. Sorry, second. What this is. Okay. Good morning or good afternoon or good evening, depending on where you're joining us from. Welcome to our webinar. My name is Eunice Bagumabo. I am one of the directors at ATBN, which is a partner on the AfriConEU project, which we're going to hear a bit more about shortly. We're hosting these webinars once a month as part of the AfriConEU Networking Academy. And we have a really great speaker lined up today. I'll just give a quick run through the program that we have for our next 90 minutes we have together. I don't know why my screen's not moving now. There we go. So we'll start with some introductions and welcome. And then we're going to have the introduction about the AfriConEU project from one of our partners, Joseph from DePixel. And then today's topic is about valuations of projects, financial management, and projections. So as you'll hear in Joseph's presentation, this is not a standalone webinar. It's part of a program, a networking academy that's focused on building the capacity of digital ecosystems in Africa and Europe and sort of encouraging collaboration. And so we've been covering various topics that we think are relevant for digital innovation hub leaders and other ecosystem actors. And particularly the last two sessions for us that we've been organizing as ATBN have focused on finance. So we talked about the traditional financing model, primarily we see in the digital ecosystem, which is sort of equity-based finance. And we talked about the processes around that and what investors are looking for and what are some of the options. We then had a webinar on alternative funding sources. So if you're not looking to raise VC or venture capital, what are your other options? And so today we're also going to look at, we really feel it's important for digital innovation hub leaders, actors, anyone who's, whether you're a startup or working to support startups, support innovation, to understand some of the numbers before. So when we put some of these projects maybe in front of investors, what are they actually looking for? How do we understand when a project is financially on the right path and is going to be of interest or sound for not only investors, but also for maybe, other options like credit, for example. But also for yourself as a business, even if you're not looking to raise funding, you want to know that your business is financially sound and is able to grow. So what are some of the things we'll be looking at? Of course, this can be a very large topic, but today is about introducing you to the concept. So you really just understand quickly what are, sometimes they say investors can look at a pitch or look at your finance slide for 2 minutes. What are the numbers they are looking for? So to just give you that sort of basic, and obviously all the webinars that I've talked about, you can go and find on the AfriConEU website and on our YouTube channel. So you can catch up on those past ones. Our sessions are quite interactive. So at the end, after we hear from our speaker, Kenneth Legacy, who is the CEO and Chief Investment Officer at Otis Africa Capital, we'll have a discussion and we'll be able to ask him questions as well. Hopefully we can also, if we can also point you towards other resources to go deeper into this topic. So please, allow me now to welcome Joseph Gaylord, who is going to do the introduction for the AfriConEU project, and then we'll continue with the rest of the program. And also, as you'll have seen when you are joining, we are recording these sessions. Like I say, we do make these recordings available and the materials available so that if you missed a previous session, you're able to catch up on. So Joseph, I will hand over the digital stage to you. I'll stop sharing and let you share. Let's see if you have.
I think I do. It looks like I have right. So, thanks, Eunice. I'm actually very excited about this topic. As part of the consortium, dpixel was responsible for drafting a lot of the discussion around how we were going to approach the topic of finance and financing for startups, and definitely echoing what Eunice said, this is a huge topic. It's something that every time I work with startups that I'm incubating and that I'm mentoring, this is one of the first things they say. How much is my startup worth? How do I figure that out? How much can I ask? So hugely important topic in terms of getting startups off the ground. So I'm going to try and throw this over to my PowerPoint presentation. Do people see it now? I imagine it's framed out, but that shouldn't be a big problem.
Yes,
okay, cool. So as I said, my name is Joseph Gaylord. I am working with a company called dpixel based out of Italy. We're part of the largest private bank in the country, and we work primarily with innovation, entrepreneurship, and startups. And I'm really happy to be able to present to those of you who don't know our project, or for those of you who know a bit about it but may need a little bit of a refresher, a little bit of information about AfriConEU. So our mission as AfriConEU is to develop the first trans-continental networking academy for African and European digital innovation hubs. We are part of the Horizon 2020 program through the European Union. Okay. So our goal is to develop this networking academy in order to support hubs on both sides in capacity building, knowledge sharing, networking, collaboration, joint project, and venture development. So we really want to be as comprehensive as possible in order to support the hubs that support the ecosystems. So how can we develop the resources for those hubs to do the best that they can? In order to achieve that goal, in order to support the digital innovation hubs that in turn support their ecosystems, we want to do several things. One is facilitate knowledge and experience sharing. How do we create connections between actors on both continents to share best practices, to share resources, to share knowledge? How do we develop mutually beneficial partnerships? How do we directly connect not just the hubs, but the actors around them? So whether that's investors that work with the hubs, whether that's the universities that feed into the hubs, whether that's the startups within them. How do we build up those connections between the hubs, between all the members of their ecosystem on both sides to develop the connection between community. Then building on those connections, building on those partnerships, how do we develop collective projects, right? How do we act and instrumentalize those relationships so that they actually build something constructive that builds up both sides of the ecosystem? The team that's working on this is all over. So we have 11 partners, 7 coming from Europe and 4 from Africa. So we have ATBN in the UK. The project lead Innova is in Portugal. The Porto Business School also from Portugal. As I mentioned, we're coming from Italy as dPixel. We have ITC Agri Food coming from Slovenia. We have Youth Makers Hub and Simile coming from Greece. And then our African partners from Ghana, we have Hapa Space. From Nigeria, we have ECA, Emerging Communities Africa. From Uganda, we have Outbox, and Tanzania, we have Bumi. So we have a really excellent transversal community of different partners working on this on both continents. And this is going to happen over 5 phases. So we completed phase 1 last year. That is an analysis of, actually, sorry, 2 years ago. I'm used to saying last year, but it's no longer last year. We're in January. So in 2021, we completed phase 1, and that was research, understanding the state of the art on the ground, and analyzing basically what the needs are. In phase 2, we developed the curriculum and the activities for the Networking Academy and its 2 flagship programs. We'll talk about those in a second. We are now in phase 3, so we are rolling out the implementation and assessment of our project. And simultaneously with that, we're doing community development and results uptake. We're trying to build that community, build those partnerships that I mentioned. And finally, communication and dissemination, which obviously runs through that. So there are 2 sides, 2 feet to this Networking Academy. This program is part of the capacity building program, which consists of local workshops hosted at those African partners that I mentioned. And then webinars like this one. There are going to be 20 of those, 12 of the local workshops. Those webinars cover a range of different topics. And then master classes, which are a little bit longer, a little bit more intensive, but always on the same sets of topics. And that's the capacity building. So supporting the ability of the DIHs that we work with to support their communities. Then we have the partnership development, which is directly taking action to build those connections that I mentioned. We completed our international brokerage event in November. We had approximately 200 participants from Africa and Europe connecting and building relationships for 2 days in Bologna, Italy. We hosted that. We're proud to do that. This summer, we are going to be hosting 4 boot camps, one at each of the different African hubs, where we are going to do design thinking process and really run through a hackathon style event. Then we have our capitalization event toward the end of this year, where we're going to summarize all the work that we did, build up those connections, and try to project that forward that we're working on. And you see below some of the key things that we're trying to develop here. So Pan-African networks, trying to build up the collaboration between different African actors. Tech hubs and DIHs, obviously, like I said, the kind of supporting those key elements of the ecosystem as we can. Involving policymakers, always a major topic, and building up the strength of EU initiatives. Trying to support specifically startups, so small businesses getting off the ground, particularly with women. Obviously, all of the dynamics that go into gender imbalance that I don't need to get into all the details of, but those are key to address and consider. Young people, and then trying to involve people on this side, the entrepreneurs, the investors, the African diaspora, and the DIH network. Really trying to build up. So as I mentioned, there are the Capacity Building Academy. We have four main themes that we're working on. So how do you develop the business model, the multi-actor approaches for DIHs to thrive in their ecosystem and to support the ecosystems around them? The technology transfer of innovative technology. So how do you bring in the technology? How do you bring in the innovation and bring that forward? Part of financial support. This is part of that third thematic, this class. And we trying to cover everything from the very beginning. How do you get seed funding for a startup? How do you get the funding to ideate and get a startup off the ground, all the way to exit? And trying to cover that whole life cycle of startups with the funding, with the eye toward funding, and digital and entrepreneurial skills development. And that has specific focus through a lot of the program on vulnerable groups. So women, young people, and so on, and people with disabilities, etc. So trying to incorporate as many different aspects of the digital entrepreneurial experience in that skills development. And then with our partnership program, we have 4 thematics as well. So moving toward a common digital market, how do we pull together the startup ecosystems in a way that's mutually beneficial? Digitalization, jobs for the 21st century. So where are the job opportunities and how do we find and incorporate talent into the ecosystems that we're building? Business and investment opportunities. As I mentioned, finance is probably the biggest topic that you hear from startups, so an absolutely key aspect. And scouting digital entrepreneurs in the African market. One of the biggest issues that you run into when you talk to European actors is they just don't know what's out there. How do we make those introductions? How do we bring people? So here's our calendar. This is specifically for the Networking Academy. So you see we started in May 22. And you can see each of the different elements of this startup. I believe all of this information should be available on our website, so I'm not going to go beat by beat through everything that we've done. However, you see we've done a tremendous amount of work trying to incorporate all of the themes together. And we've run a number of workshops and master classes so far. Again, you should be able to find the recordings of at least the majority, if not every one of those, on our website. And also, you see on there the international brokerage events we did. From here, you see we have 5 activities this month, and for next month, you'll be able to see all of the information about how and when and where we're doing all of this on our website at AfriConEU. Registration to attend, all of our activities are free. Registration is needed, but everything is free. Everything is open to whoever wants to join. There's no limitations on those fronts, up to obviously capacity. Yeah, so that's a super brief version of what we're doing as AfriConEU. I hope people will go to our website, as I said, AfriConEU.eu, and see what we're doing, get involved, join further classes. As Eunice said, this is one small part, right? This is how do you do valuations and projections, financial components, but we're going to, on the financial side, cover everything across the life cycle of startups. And there are all of the other components of how do you bring in technology, how do you build a solid business model, how do you build up skills, especially for the vulnerable groups that I mentioned. So please take advantage of the work that we're doing. We're bringing this for the people here in the program, and please share the word with your community. This is for all of you, and I really hope that you'll be able to participate yourselves and bring it out to those around you who could benefit. Thank you.
Thank you, Joseph. And now for our next part of the agenda, I would like to, so I'll skip this. I'll just do, this was a quick intro about ATBN, but I'm going to skip this so that we can go to the speaker and start on time. However, please do, we'll share our details as well at the end of the session. But I'll just skip right into introducing our speaker for now. I'm very happy to welcome Kenneth Legacy, who, like I said, is the CEO and CIO of Otas Africa Capital. I think one of the things that I'm really excited about is Kenneth can actually brings together a perspective of Europe and Africa together, right? So he is from Uganda and also living in the UK and has worked across both continents quite extensively in the sort of capital space. And that is kind of very, the heart of the AfriConEU project, as you heard, is, sort of bringing perspective from both sides and sort of understanding where there's mutual benefits and where we can learn from each other. So very excited to have a speaker who can sort of speak to both those perspectives. And I'm sure that we'll all take away a lot from his presentation today. So Kenneth, I won't do a lengthy intro because I know I won't do it justice. So I'll let you introduce yourself when you start. But I just wanted to hand over the floor to you now and just confirm that you have permission you're able to share your screen.
I'll just check now if I'm able to share my screen. I should be able to share screen. Yes, it says I can share my screen.
Great. So over to you, Kenneth.
Okay, thank you. So good morning, good afternoon, wherever you are, everyone. Just confirming that you can see my screen and it's showing the title page.
Yes.
Okay, good. My name is Kenneth Legacy, as introduced by Eunice. I lead the team at Otas Africa Capital, and I'm glad to be here to share. Today we'll be talking about valuation of projects, financial management, and projections. It is a lot to try and do in the time we have, so I'll be lying if I said I'll cover everything, but hopefully you'll get a flavor of what we are discussing today. So that will really entail, we'll look a bit at I'm just trying to move the cursor. Good, move it to the top. That will entail just, I'll not spend too much time talking about Otas Africa Capital. These days you can go to our websites and look up people on LinkedIn and see what they do, and you can inbox if there's any questions you want to ask me. But I'll just touch on expectations, why we do valuation. I'll go through the valuation methods together with case studies. Hopefully they'll help some of you, but it won't be as detailed. I was going to show on venture valuation methods, but I've put one of the methods of venture valuation at the end, and then I'll go to the role of financial management and projections to support valuations, and then just wrap it up. What we do at Otas Africa Capital, we are an advisory and investments firm. We started in 2019, actually 4th of July 2019, so coincided with American independence, and we are focused on advisory and investments in the what we call alternative investments asset class. So we focus on venture, private equity, real estate, infrastructure, commodities, and we help investors or businesses that are in that space. We have experience across different sectors. So we don't do just financial services, but we'll advise on energy, natural resources, consumer and retail. And we also don't just advise, but run our own funds internally. Currently, we have one in the venture space and in the credit space, which we are deploying. And so we are always open to hearing from people who want to co-invest with us and or who are seeking capital and would meet the criteria as we invest. So just so I can manage and understand expectations, I'm going to just request that, I don't know, I'll see it, I'll look in the chat, but maybe just 3 things to ask. 1, what do you know about project or business valuations? 2, why do you need to know about project or business valuations? And 3, do you know any venture capital methods for valuation? So I'll request maybe that you can just type in the chat. For question 1, on a scale of 1 to 10, what do you think you know about project or business valuations? I'd rate myself maybe as an 8, because there's things maybe I don't know about, very specialist businesses you need to value. Why do you need to do project or business valuations? Usually I have to do them when I'm raising funding rounds with startups I'm working with. And do you know any venture capital valuation methods? I'd say yes. So if you could just type as, there are 3 things, so you can separate by a slash. I've shown an example there, just what you know about valuations, scale of 1 to 10. Why do you need to do valuations? Just a single reason, most important reason. And then whether you know any venture capital valuation methods. That's going to be a simple yes or no. Then we can see the answers so that it can frame as we discuss. I already see people have shown 1 and 3. So people on the low end of the scale. And I see 2 coming in there, and people don't know about venture capital valuation methods. William would like to raise funding, Eunice to better support entrepreneurs, and yes, everyone is less than 5 out of 10. Okay, so I'll see the responses as we go through. I'm seeing them, and I'll try and tailor what I'm saying to suit. But I can't promise that we won't be too heavy on the mathematics. But I'll just try to make it as simple as we can. So for a starter, we get a flavor for what the big picture is. Right. So why do we do business valuations? And I can see this in some of the reasons you're raising. But we do valuations for a number of reasons. 1 second. We do valuations for a number of reasons. This may include just selling your business, may include raising money, may include tax requirements, maybe because you're looking to make an investment decision, maybe internally for certain projects that you're thinking of pursuing. You may want to give employees stock options, and you need to do evaluation. And then recently, I actually as an expert witness in a litigation case. So we had to use to do valuation as part of a litigation. We're assessing the value of damages that a plaintiff was claiming, and I was acting on behalf of the defense. So these are all the reasons. But for the people on the call, I'm suspecting it's mostly the 3 I've highlighted in red. Maybe you're selling a business, or you're raising capital, or you're advising entrepreneurs who are looking to raise capital, or you're going to invest in a business that is raising capital. And then maybe you're valuing what you want to pay in employee options and as compensation. So that's why we tend to do business valuations. So as you can see, the reasons are a bit diverse. So when we go ahead and do business valuations, it's important to just understand then what is a business valuation. The formal definition really is that when you're doing a business valuation, you're trying to determine economic value of a project, or maybe of a company or a business unit, for the various reasons we've highlighted below. And there is a method you take and a way you go about doing that valuation. So you may, and maybe key to note is that valuation is based on expected future performance and not really past performance, because when you value, what you pay for a business is a certain price. What you get is the value that you've paid for, and that value is going to come in the future. So it's important that you're looking at the future performance of the business, not historic. And the process you usually take when you're going to do a valuation is you look at historic performance to help you project the future. You'll forecast the future, but in forecasting the future, you look at an analysis of the industry in which a business or a project or a business unit is operating. You look at an analysis of the economic environment. For example, right now we're in high interest rates, downturn in the economy. So cost of capital is gone up because interest rates are going up. And that has implications of valuations of businesses. So we'll see that already sort of depresses the value of businesses always. So when you've analyzed historic performance, forecast the future, analyze the industry, analyze the economy, you then need to take all that and apply it to the acceptable, and I use the term acceptable, valuation methods. You don't just value any way you want to value. There is standards and accepted methods of valuation. So you take your knowledge and you apply it to those acceptable methods of valuation. So what we're going to look at now is what those acceptable methods of valuation are. So they are generally, and I've highlighted them in bold, there are three fundamental methods of valuing businesses, and all other methods of valuing businesses tend to be a variation on these methods. The first one in the table here is an income approach. So any business or project or venture is worth the cash it can give you in the future. So in the income approach, you look at what that cash you're going to get in the future is, and you discount it to today. The other method is what we call an asset approach. With this approach, you're looking at what are the tangible assets of a business, and then you pay someone what the value of those assets are. Then the third one is what we call a comparables approach. With this one, you're looking for either comparable businesses or you're looking for comparable transactions that have happened similar to what you want to value. So for example, if I'm buying company X and similar companies to it traded for 3 times net profit, then I should not pay more than 3 times net profit for that company. Or if they traded for 2 times sales, I should not pay more than 2 times sales for that company. So that is a comparables approach. The other methods that I've listed below are the ones that tend to be used for startups at a very early stage, but they are usually a variation on those first 3 methods. So the Barkas, so you're looking at success factors needed for a business, and you assess the business on each of those success factors. Risk factor summation, you're looking at risk factors associated with the business, and then you score the business on those risk factors and then come up with the evaluation. Scorecard, you're looking at a comparison of similar businesses and looking at what the weighted average of the value of those similar businesses is and apply it to the company, the business or project you're trying to value. First Chicago is more a scenario approach. You value a business using different methods, and then you look for a weighted average based on the different scenarios for whichever method you're using. And lastly, the venture capital method. This, as the name suggests, is used by a lot of VC investors because they're looking at the return they want to get from an investment. They value based on return on investment they expect as an investor. So if I'm paying 1 million to buy a company today, and I expect an exit in 7 years, what value should I get in 7 years such that the return I'm getting on my 1 million is, say, 25% annualized per year? And so when they do that calculation, they'll know what stake they want in your business today to be able to achieve the return they want in say 5 years when they exit from your business. So this is an overview of the valuation methods. We'll now look at the first 3, so you understand just the fundamentals. And as we go along, we'll be defining certain key concepts for you to appreciate them. When you know the first 3, then you can have intelligent conversations with maybe advisors when you're working with them, your own startups as you advise them. If you want to go in depth, this hopefully gives you a basis to go read further so you can carry out this valuation on your own if you need to, so you have your opinion. But I'll just caution you that valuation is a back and forth, you're haggling. And so people will have their opinions. The important point is just to know what are the assumptions underlying and have you applied the method correctly. So that's key. So we'll just go into the first 3 one by one, and then we'll then see what the role of projections are in being able to do valuations. So the first up is the asset approach. I'm doing this first because it tends to set a floor for valuation of business. It tends to be the minimum you should be paying for a business. And really, in its simplest form, we're just saying a business is worth the total assets it has minus the total liabilities or what it owes to come up with what we call a net asset value of the business. In the event or in the case of a startup, you're looking at maybe what it would cost to recreate that startup today. So you'd be looking at maybe Is there hardware you had to buy? Is there developer time that was expended and inputs? Did you have to pay for maybe subscriptions and licenses? Did you file for any patents, and what did that cost? So when you take all that, that is sort of the cost to recreate, and maybe you can take that as what is the asset and what is valuable. And if there are any liabilities you incurred in coming up with that, you deduct them to come up with a net asset value. So the limitation with this is that it may not deal with any intangible value that a business may have. And also, as you can see, because we're looking at the costs that have been incurred, it tends to be backward looking and tends to be historic. Because those costs that you've incurred and those assets that you've created are the ones that are going to be used to generate cash flow in the future that is probably more valuable. So that's why we say the asset approach tends to provide a flow for valuation of the business. And what you're seeing here really is an example of an application of the asset approach. This was, it relates to a bank, but we can still use it to understand, to drive the point home. So this is an example of a company that has certain assets that include cash, that include investment in government securities. Because it's a financial institution, it makes loans, so those loans are assets. It has property. It has investments in equity that may not be listed. So this may be startups or other projects. Those total assets are worth about 139 million. Then it has certain liabilities. It took money from customers so that it could lend that money on. In addition, there are some other liabilities it owes. Maybe there are salaries that need to be paid. There's suppliers that need to be paid. There's rent, there's marketing expenses. So when you deduct the assets from the liabilities, what remains is the net asset value, or the equity, or the value of the business. And that is represented by the total shareholders' equity. In the case of a bank, because there's certain provisions, you need to provide share capital. There'll be a premium on share capital. You'll have maybe profit you've kept from prior years. There'll be certain reserves you need to make as a statutory business. So all these are part of what makes up the net asset value of the business. So this is an example of the asset approach as applied to valuation of a business, and that is just how we apply the asset approach. And Eunice has asked the question: what if you use developer time, but the developer worked for free, so he didn't actually incur the cost? Can you include it by using the market rate for the time of developers? The short answer is yes, because I'd expect that developer, okay, you're saying they work for free, but maybe in exchange they could have got an equity, or you would have been paying someone. So yes, you'd look at that equivalent market rate for the developers and the time. So you quantify what that developer time is. Yeah. So that's the asset approach. We'll look now at the income approach. But before we go through the income approach, and please, as you have questions, please feel free to type them in the chat, because if we wait till the end, you may forget things. As we go through the income approach, we'll define certain things, because the income approach is based on the future cash flows you expect and what their value is today. So it's important to understand the concept of net present value. So net present value is really the value of a series of cash flows you're going to get in the future today. What is their value today? Yes. And the way we tend to do it, we tend to think of the cash flows, and we think about what is called the cost of foregoing that consumption today, what we sort of call our opportunity cost or our cost of capital. And I'll illustrate with numbers. Let's imagine a project or company you want to invest in, or business you're thinking of buying, for which you have to invest $100 million, 1,000 today. And that project you expect is going to give you $50 or million in a year, 150 in 2 years, 200 in 3 years. The money that you're investing today, the 100, may have cost you, say, 10%. Say you borrowed that money. So because you borrowed it, that is the cost of capital. So whatever you invest in, and we'll come to the concept of IRR later. So whatever you invest in should be able to give you a return such that you pay back at least that 10% cost of capital. So whatever cash flow you're going to get in the future, its value today should be worth the cost, should be worth the foregone cost of capital, the 10%. So any money you're going to get in the future, you need to get what it's worth today by doing what we call discounting it at that 10% cost of capital. And we'll see there's formula you use to do this discounting. You can do it very easily once you set up this in Excel. But suffice to say, when you discount that today, for example, for this project, if you invested 100 today and it's going to give you 50, 150, and 200 over the next 3 periods at a cost of 10% of capital, what it is worth today is 219.68. So the rule generally is when you are going to invest and you know the future cash flow, you only invest if the present value, the net present value of that project is positive. So if you're a hub and you're going to invest in space, and the space is going to cost you maybe $100,000, and you know that in year 1, year 2, year 3, you'll unlock revenue through maybe grant programs, through rental income from startups, that is worth so much. To whether you should invest in space or not, you need to do this kind of calculation very quickly. So that is the concept of net present value, and you'll see how we apply it to valuing businesses. Then the other concept to define is the concept of an internal rate of return. So an internal rate of return is that interest rate of value of savings annualized that you realize from future cash flows that makes the value of future cash flows today equal to the value of outflows, your future cash inflows today, the value of the cash outflow you're making today. In other words, what rate of return do I need that would make the 100 I'm spending today equal to 50 plus 150 plus 200 today? Yes. And so in our case, the internal rate of return is 87.2. Again, another test. Your internal rate of return should be greater than your cost of capital for you to carry out a project. So in this case, you can clearly see our internal rate of return is 87.2. Our cost of capital is 10%. So you will hear people usually use the term hurdle rate. So a hurdle is something you jump over. So again, if our internal rate of, so the cost of capital then becomes our hurdle rate. So if our internal rate of return is not more than our hurdle rate, then we shouldn't carry out the project. Yeah. So that concept is important because we use it then to be able to do the whether we should carry out a project or not. Yeah. Yeah. Okay. So yes, you make an important point, Chinenye, because sometimes what you spend, the cost, may be different from what its value is. So from an asset approach, you'll do it at that cost, but you could mark it up to what its value is. And then you have a discussion and argument back and forth on what people think its value is, because they might say, oh, I could have done that cheaper, or I don't appreciate that it's worth that value because I don't see the income it's making me in the future, and so on and so forth. So yeah, we've defined now net present value and internal rate of return. Let's see how you apply it in the income approach, because the income approach, also called the discounted cash flow approach, just takes the cash flow a business is going to make in the future and sees what its value is today. So this is showing you on the right a practical application of the discounted cash flow approach using actual numbers for a business. And then on the left, we're just looking at just more text and discussion on this income approach. So as we've said, the income approach converts future cash flows into a single present discounted value while reflecting the expectations about that future cash flow. So the expectations about that future cash flow is just a fancy finance way of saying the discount rate or the cost of capital you apply to those cash flows. And value in the income approach or the discounted cash flow approach is based on the income or cash flow the business will generate in the future. And like I said, unlike the asset approach, we are now taking into account the potential income or cash flow that can be made by this business or project or investment. And we are going to define different types of cash flow. I made a general statement that we are looking at the cash flow a business is going to make in the future. But a business or project makes cash flow that is paid to different providers of capital. So when I go to a bank and take a loan and the business makes cash flow, some of that cash flow will be allocated to the bank loan. Then after I've paid the bank loan, the cash flow that is left over will be allocated to the owners of the business, who are usually who are called equity investors. So when you're doing this cash flow and discounting it, it's important that you know that the cash flow you're discounting is to the right source of capital, and that the interest rate you're using or the cost of capital you're using is for the right type of capital. So that is just a key point that you need to take away. So it is very common when people are doing valuations to pick the wrong kind of cash flow and discount it by the wrong cost of cash flow. So it's important you're always matching the right cash flow to the right cost of capital and therefore discount. And that usually helps us to define whether you're valuing equity or you're valuing what we call enterprise value, which is the value of the business as a whole to all providers of capital. That is different from the value of the business to providers of equity capital. So if you are a startup and you're the founder of a startup, what you're interested in is the value of equity of your business. But to get the value of equity of a business, sometimes you need to first understand the whole value of the company, and then you have to subtract, you have to add debt and subtract cash. And we'll come to you have to subtract debt and add cash. So, and we'll come to that concept in the next valuation method. So this here is discounted cash flow or income approach and how you use it to value a business or project. We're going through this quickly, and I'm trying to make them as simple as possible so you get past the first big picture, and then you can go into depth. We've not gone into the detail. For example, how do you develop the free cash flow? How do you determine the right discount rate? How many years should you project for? So for example, here you see they've defined on the right a concept of terminal value. So what has happened here is, for example, they are projecting maybe 2018, 2019, 2020, 2021, 2022. And then in 2023, say, they are saying maybe in 2023, you can sell for a certain price, or the terminal value at that point is, say, a multiple, 3 times sales or 3 times earnings. And then they are discounting those cash flows because you can't project the cash flows of a business in perpetuity. So it's important to know just the framework of how you're using this. And then you can see here that they've applied a cost of capital of 10%. Yes, 10%. So if you get 91 million in 1 year, in year 1, what its value is today is 91 divided by 1.1. And it's the concept of future cash flow versus present cash flow. If you get 83 in 2 years and the cost of capital is 10%, then 83 today is worth 83 divided by 1 over 1.1 squared. So these are what are called discount factors. And you multiply them by the cash flow you're getting to find out what that cash flow is worth today. So that's the discounted cash flow method. We'll now move on to the comparables method. So for the comparables approach, as I said at the beginning, the quick definition, you're looking at either comparable market multiples or comparable transactions. And by comparable market multiples, we just mean companies that are comparable. So it means you need to know, first of all, the commonly used multiples for similar companies in that industry. You need to then find those commonly used companies to come up with their metrics and create a database for them. And then you apply those metrics to the company, the business or project you're trying to value. And we'll see an example in a second. But what are some of those examples of multiples? And whenever I say price here, price refers to the price, the value of equity. Chinenye, that is right. It meant that if you have 100 and you discount it at 10%, what it is worth today is 91. Yes, that is true. That is true. And if you have 100 and you discount it at 10% in 2 years, what is worth today? Yes, that is how you apply the formula. You're right about that. So when we talk about price to earnings, this is the ratio of the price or the value of the price you pay for the equity value of a company to the net earnings of each share of that company. So it is a ratio that defines the price to earnings. You'll see it common for listed companies, especially. Enterprise value to sales. This looks at the ratio of the enterprise value of a company to the sales that the company has made. Sales is sales, revenue, turnover. What is enterprise value? Enterprise value is, and we'll define enterprise value just in a minute. Enterprise value, I've shown it at the bottom there. Enterprise value is the value of a firm or a company. And it comprises of the value of equity of the company, the debt that a company has, minus the cash that a company has. From this formula, you can see that if you calculate the enterprise value of a company, to find what the value of equity is, you can see that the equity value of a company is going to be the enterprise value plus cash minus debt. So you just make equity value the subject in this equation. The other ratios that are used may be price to sales. Again, the price of a share or price, the value of equity of a company to the sales that the company is making. So these are some of the multiples you tend to use when you do the market multiples approach. Eunice, you're right on the DCF. It's a risky way to value. Cash flows may never materialize. That is why you may apply probability to cash flows. That is why you run scenarios to gauge. Yeah. And the way an investor gauges if your projections are realistic, that is what due diligence is for. I'll ask you, okay, you say you're going to make this revenue. Show me which customers you have on board. What price are they paying? Will there be pressure on that price? Show me the quantity of sales you've been making. How sure we will guarantee that sales? Do you have the capacity in asset base? Do you have contracts that are already locked in? Are businesses more stable as customers versus individual consumers? That is why you do the diligence. So you can gauge if projections are realistic. Can I see your competitors? What percentage of market share do you have? Therefore, I can know whether you will actually achieve those sales, because you may be suggesting sales that indicate you'd have to own 50% or 60% of market share. Is that realistic? So yes, this is why you do due diligence, to be able to ascertain whether things are those cash flows are realistic. So yes, just turning now to the comparables approach. We can use either market multiples, as we've shown, or we may use what are called the transaction multiples. With market multiples, you are looking at similar companies in the same market. Sometimes you may need to adjust. With transaction multiples, you're looking at similar transactions. But again, you may apply the same multiples, only that you're looking for similar transactions. In geographies like Africa, because we don't have deep stock exchanges, we don't have many comparable companies. So when we're using these approaches, it's usually a challenge to find comparables. So most times you'll find you'll use more developed economies multiples because there's abundance of data, and then you'd adjust that data. But there is an opportunity here to be able to build a database of comparable transactions or multiples that we can apply as a community. So for comparable companies, you always look for, the marker is usually revenue that is close to the target, that you're looking to value. And like I've said, usually there's limited applicability because you don't have recent transactions. Just a key takeaway then, for comparables approach, there are certain key questions you need to be able to answer before you use this method, or as you're thinking of using this method. So which are comparable companies or transactions to my company? What are the key metrics you use for valuing companies in my sector? Am I in SaaS sector? Am I a fintech? Am I in agriculture? Am I a real estate business? What is the right multiple metric to use? And then the question, of course, then is, how can you reliably estimate that metric? Whether it is users, sales, EBITDA, profit, customer life value for your company. And then lastly, you're looking at, can I find recent transactions that have been completed in my industry? So the reason why transactions like Jumia listing on the stock exchange in the US, or Flutterwave raising another funding round, or Jumo raising money, or Cheaper Cash, and knowing how many users they have, or how many countries they're in, or how many employees they have, is because all that data gives you metrics to be able to start to do these valuations as comparables. That is why you're collecting all those metrics, and that's why we track that data. That's why all these companies exist, to track that data. So this is just an example of applying the comparables approach for a pre-seed SaaS startup. I use this for a business as we are looking to invest in as Autos Africa. I've changed the numbers, of course, for purposes of the example. But if, for example, you had a company that has leading up to this year has been tracking these sales. These are monthly sales: 921 in September, 1,000 in October, $1,700 in November, 2,100 in December, on track to make 2,400-ish in January, 3,100 in February. You can see here that the revenue is growing at a compound annual growth rate of about 28% as at December. And we've sort of looked at September to December, and then we've run a formula in Excel to find what the compound growth rate is. If I look at that compound growth rate, the annual recurring revenue the business may be on track to make is about 39K. In other words, over a 12-month basis. In January, basing on the growth rate, it's on track to make 30K annual recurring revenue. And in February, it's on track to make 44K. Now, when I want to invest, and say we're considering a safe, and we want to invest, say, $5,000 for a stake in the business. When I look at the SaaS companies multipliers out there, the range I found was that you pay for SaaS companies anywhere between 4x to 10x of sales. So applying a ratio of 4x to 10x on annual sales, it means that if you are to pay $300,000 for this company, or as a valuation, you've paid 7.6x multiple of sales. And then you just compare that to your range. You can see it is a bit closer to the higher range, but it's sort of in the middle. So when you're negotiating on the other side with the entrepreneur you're going to invest in, or if you're the entrepreneur and you're negotiating with the investor bringing money, because you have this data and this knowledge, you can then know that if they're bringing $5,000, say, into my company, the stake I should be giving them maybe is 1.67% of my business. So it means you can then write your safe and say, you're going to invest $5,000 in my company on a safe with a valuation cap of, say, $300,000, and you may apply a discount to it. And so based on that, on this little exercise, you can see we've applied a comparables approach, a multiples approach to come up with a valuation for a pre-seed SaaS startup based on numbers we've seen for their revenue. Yeah, of course, if the company had come back and said, no, we want to do this transaction at, say, 600K, you can see that the multiple they are asking for is then double that, which is outside the range, and you'd say, no, you're too expensive, I'm not going to invest that price. Because remember, this valuation in subsequent rounds, subsequent investors will see, will get a feel for this valuation because they'll do their numbers as well and come back to the same. And it has to be realistic when they compare to benchmarks. So this is an example of a comparables approach. This is also another example of a comparable approach. This is using more ratios than before. So again, like I said, the method, the way it applies, you need to find comparable companies. So here we've listed, say, 10 comparable companies. For those companies, you may have data on their price to equity, price to earnings, enterprise value to sales, enterprise value to EBITDA. EBITDA is a measure of operating profit. Then you may have maybe market value of equity to price before tax. So again, that's a measure of profit. So you run those comparables for the comparable company. You run what those ratios are. When you run those ratios, you can find what the mean, the median, and what the average of that ratio is. And then you can apply a discount. Because remember, when you find these comparable companies, they might not be in your geography or market. The companies you find that are comparable may be too large. So you need to apply discounts. So usually you apply a discount to the multiple. If we took the example of, say, price to earnings, we've applied a 12.4 discount to the multiple. It means we get a multiple of 9.1 times after applying the discount. Then, because you're buying usually a private company, it is not as marketable or liquid to sell as a listed company. So you usually apply a discount as well for marketability. So then the multiple after discount is about 8.5 times. So once we know this multiple, based on comparables, we can then apply it to the company we're trying to value. If, for example, the earnings of the company we're trying to value is like 6.5 billion, shillings or dollars, applying that multiple up there gives you then a valuation for the business. So that is just how we use this comparables method. Eunice, you're asking what's the basis for deciding the discounts? The discounts are based on, yeah, that's the thing. The discounts are based on the standards out there of discounts. So if you go and do the research, you'll find certain discounts that are listed by Damodaran, who's a professor at Stan and is collated a database with these discounts. Or if you're an investor and this is what you do for a living, you know the discounts you've applied in the past. Or as well, depending on what discount you need to get a return, you know what discount you can apply. So there's different ways people apply these discounts. Yeah. So that is that is the comparables approach. This is another example of how you'd apply it. So that brings us to the end of the different valuation methods, the three key ones. All the others are then a derivative of those three methods. However, you'll have noted that to do valuation, it's important that you have projections or that you have data on a business's performance. So that's why financial management, good financial management practice is important. That's why being able to derive projections is important. So all the questions you've been asking are answered in part by having good financial management practices and by being able to develop good projections. So one, you get unbiased views of a company's economic status and the path it might take in the future. Second, you're able to prepare for the kind of expenses and revenue you may get as a business. Third, you're able to come up with goals, because if you know the kind of valuation you need to hit in the future, you know the kind of revenue you should be tracking against the expenses, and therefore what profit you should be hitting and what cash you should be making to be able to hit that valuation and either get the right return for your investors or the right return on that project. And then when you develop projections, the actuals can then track against that projection to see whether you're growing your business as predicted or you're growing it actually even better than predicted. So it's important really that that you have robust abilities to do these projections and do proper financial management. And then then as well, you can see how you compare and track against the wider economy and peers. And lastly, you can then use that to mitigate. Do you need to cut costs? Do you need to change where you're tracking and growing revenue? For example, you may identify certain segments of the business are growing compared to others, and therefore you should prioritize those segments. Do you need to find alternative source of financing that is cheaper because it increases your return? So these are all the reasons why financial management and projections are important. There are certain markers that are tests of good financial management. And because I haven't had time to start going through a financial management session, but one, a test of whether you have good financial management practice is just the ability to file a tax return and be able to get a tax clearance certificate in whichever jurisdiction you are. Because if you're able to file and get a tax clearance certificate, it means you've gotten a tax identification number, you've logged the revenue your business makes, and you're paying VAT against it. You've logged the expenses you incur and therefore are deductible against tax. You've logged the profitability you've noted. You've run an audit process and therefore gotten audited financials. And based on those audited financials, you've done a tax computation that is acceptable to the tax authority, and therefore they are able to issue you a tax compliance certificate. In addition, all your directors have also filed their tax returns. So for me, that is the test. And usually as an investor, when I come to your business, I'll just tell you, give me a tax clearance certificate for your business. And if you're able to generate that, it is testament of your financial management practices. So that for me is a quick shortcut. Turning to projections, to be able to do financial projections, you need then to take certain 3 elements. Have a good knowledge of accounting and finance, which is what I've just been talking about around the financial management of your business. Have good, it helps to have Excel skills, but these days there are tools that are being modeled that can help you build financial models and projections without Excel. But Excel remains a core, and it's like the OG of financial projections. And then thirdly, financial projections are about just following a logical flow. So that's what we tend to do. So we'll just go into projections. You're not going to be experts at projecting because of what we're doing today, but you'll get a flavor, and hopefully we should be able to do it on your own following. As you're planning to project, projections usually don't go beyond 3 years. You may find some people doing 5 years, but usually it becomes harder to project the further you go into the future. The exception is maybe in project finance. Now, project finance are the type of investments where the revenue you're going to make is sort of set, because you maybe have a concession that gives you a right to charge people a tariff, and or government is going to, or a certain client is going to pay you a certain set revenue for the next maybe 20 years. Yeah. For example, you may be a company that builds or leases equipment for mining. And the largest miner in the world says, for the next 30 years, we're going to use your equipment. This is how much we'll pay you for having it on site per year. And you can project your costs against it with inflation, but most times you don't project beyond 3 years. It is hard to forecast beyond 3 years. And so when you're planning, it's important to first understand why you're doing this. Are you projecting towards liquidity event? Are you building a company to sell? Do you want to know when you break even? Second, you then need to build a model that will be used to enter data on things like headcount, on operating expenses, capital expenditures, revenue. And usually your historic financials are a good place to start. And that's why financial management is important. Third, you need to then understand key drivers around cost of your services or your goods, because they help you understand inventory that you need. They help you understand money that you need to have available to be able to generate revenue. And by inventory, we mean if you're selling widgets, or you're selling maybe farm equipment, you need to know what it costs you to buy that farm equipment. That is your inventory. If you're selling time, you need to know how much you pay the people whose time you're selling. Yes. If you're selling access via a SaaS platform, you need to know what it costs you to have uptime for that SaaS platform. So when you have what you're planning towards and you've collected this data, you can then feed it into the financial statement templates of an income statement, balance sheet, a cash flow statement. Some of the questions you need to ask as you're building up the model are, so what tools maybe do you need to do your job or to sell to people? Where are you going to put them? Are you going to use them as over more than a year, so they are assets, or within a year, so they are consumables? What type or how many employees do you need when? How long will you stay in the market before you sell? Do you need to rent or own a building? Do you need telecom infrastructure? How will you market and go to market? Will you be online? Will you be inbound and people come to you, therefore you don't spend much on marketing? How big a sales team will you need? Will you need it all today? Will it grow over time? So this is all the data that you need to collect before you go ahead and start to build projections. So on the next one, now we're going to just see how you tend to use this. And I'm not going to build all the financial statements. I've shown the steps you follow on the right, 1 to 10. And what I'm showing in this diagram is just a snapshot of the way you do this. For the years 2012 to 2016 in this diagram, you see we are showing historic performance of the business. From the historic performance of the business, there are things you're able to tell that you can use for the projection. For example, you're able to tell what revenue has been growing at, on average, what the cost of goods to sell are, on average, what marketing expenses are as a percentage of revenue, and so on and so forth. So the way this tends to work is you use your historic results and to develop assumptions. You then model your income statement by looking at revenue, your cost of sales, your expenses to arrive at profit. When you've done that, you can then start on the balance sheet. The balance sheet really just notes how much investment you need, in other words, your debt or your equity, and then what you're using that debt and equity for, what assets you're buying and working capital you're spending on. When you've built the balance sheet, you then need supporting schedules, because for each of these items, for example, when I say revenue, you may see a revenue line here in the financial projections, but there's a supporting schedule that breaks down the revenue in detail. I've not shown it here, but you need to build up those supporting schedules. And then it allows you to populate detail further on the income statement. When you have the income statement and the balance sheet, you can then build out the cash flow statement. And that allows you to then do the discounted cash flow analysis and to do any sensitivity analysis. And a good way then to visualize your financial projections is usually in charts and graphs. And then you can stress test and audit your financial projections. By auditing, you just want to see, do the formulas make sense? Have I not made errors? If I maybe increase the OPEX, at what point does the business not make profit, or does it take long to break even? So all those are the kind of stress tests you need to run. If you want to learn further, as a firm, I know we run this kind of training. We've just been doing it for some organizations, but there's resources online you can go and look at. The Corporate Finance Institute is a very good one. As you can see, this diagram is from the Financial Modeling in Excel course provided by the Corporate Finance Institute. So that's how you do projections. Patrick, your question is very vague. Is it wise to use comparative approach in an environment of disruptive companies? I don't know what you mean by that, but even in an environment of disruptive companies, you'll always try to see comparables. But I guess that's why people are then willing to pay very high multiples for companies, because they think they are disruptive. And so it's up to you to gauge. For example, if the multiple for price to sales of a company that you could think is comparable is, say, 10x maximum, like I showed, but you're willing to pay 20x for a company, is it because you think it's so disruptive it will justify that? It is up to you to answer that question. But like I said, the methods are a basis and a starting point. So we've looked at projections. Associated with projections is knowledge in Excel, but I'll not dwell on this. You can read this at your leisure when you get this presentation. There are certain formulae and tools and tips you use when you're projecting in Excel that you can look at. I think that brings us to the end. I'll just wrap it up. We've looked at what business valuation is. You're trying to determine economic value of a project or business. And when you do that, there is methods, various methods you use for doing that. The key ones being the income approach, the asset approach, and the comparables. And then to do that, this valuation, it's important that you have good financial management practices. I told you a test is whether you can generate a TCC for your business, or you can successfully undertake an audit process for your business, even if it's a shadow audit. And then lastly, with good financial management and data being collected, you can carry out, do financial projections. We tend to use Excel when we do this. To be able to do financial projections and to model, it's important to get a good understanding of accounting and finance knowledge. Usually it's done in Excel, and problem solving and logic will help you to build models for projections. This presentation has some of the resources we've used. You can go look them up and read some more. But yeah, we'll open it up to discussions. I hope I didn't take too long, Eunice. Thank you.
Wow, that was so good, Kenneth. Thank you so much. I don't know about everyone else, but I'm going to have to go back and yeah, really study some of that. But I learned so much. We probably have about 10 minutes that we can do for questions. And I think it was really good that we kind of kept asking as we went along. But I don't know if anyone has any questions. I sort of asked mine as well. So does anyone have any further questions?
Type or unmute and speak. Just
Yeah.
one I've added in here at the end of this presentation. I know most people are interested in the venture capital method.
William, go ahead. You have your hand up.
On the venture capital method in your leisure at the back there with an example. So you see how it gets applied.
Great. And we shall share this. We can share these slides. Yeah.
Yes, you can share them. I'll send a PDF across.
Sure. Thanks, Kenneth. Thanks, Kenneth, for this detailed presentation. Maybe mine is about the benchmarks. Since you guys are at the center of some of the ecosystem you have, you see in some of the data, which kind of benchmarks are you seeing around the multiples across Africa for different rounds, like seed, pre-seed? Okay, I know you always do a lot of pre-seed and very early stage companies, but still you advise also on big deals. So I'll be glad to hear the kinds of benchmarks on different multiples, especially around East Africa and Africa, or even specifically Uganda for different.
I won't lie to you. There is, you know, it's a case by case. Whenever you have to value a certain business, you then go and find the benchmarks and see. But yeah, maybe we actually, that's a good idea. We should be finding. We can just for each valuation exercise I'm doing. Maybe we can start collecting some benchmarks to see. But now the multiples I shared in the examples I was showing here are actual. Some of the examples I gave were from actual transactions. For example, the multiples I gave, and when we go back to this here. For example, this one was, for example, a construction company. So this was for valuation of a construction company. So these were multiples for a construction company. And then this was for a SaaS company. Again, I looked at multiples out there and benchmarks. So again, it's really going to vary as the industry. If you've been seeing, if you follow things like TechCrunch, Digest Africa, I don't know if they're doing it at Brighter Bridges, probably they've not started, but whenever funding rounds are announced, you can glean from the data what kind of multiples are being applied. I think in my, I don't know if I have it somewhere, but I don't know if in my notes, I did something for FinTech and I did Flutterwave. I just need to check if I have it. So I took Flutterwave and I just looked at what the implicit multiples are for Flutterwave. I think I have it in my data somewhere. No, I don't. Oh yeah, okay, I have something. Yeah. Let me just share something. New share. There. So I did this, for example, when I was looking at Flutterwave. It is not much, and this data is hard because most times they will not show. So this was, I'll do a shout out. You can see at the bottom there, one of the companies I co-founded to solve exactly the problem of lack of data in valuation and diligence when you're investing in Africa is Digest Africa. And we've been collecting data on funding rounds and what it means. So what you're seeing here is an analysis that we did, the team at Digest Africa did for Flutterwave. In the earlier rounds, you can see there's not much data. So what you're seeing here is the way the funding rounds have progressed over time. You can see the amount of money that the company has raised. You can see the cumulative capital raised. Then you can see the investors. But what's important here is the valuation. So they've stated the valuation in the later rounds, 1 billion, 3 billion. You can see the multiple of capital invested. You can see the transactions multiple. Based on the kind of transactions Flutterwave said they were processing at the time. You can see the gross payment volume multiple. You can see the number of businesses multiple. And you can see the revenue growth as at that time. So for you as a business, if you're raising at maybe, it's not ideal because you might not be at Series C, but if you're raising at Series C or Series D, this starts to give you an indication of what transactions multiple people would be willing to pay. So for Flutterwave, they were paying 7 times the gross transaction volume. 7 times. They're paying 7 times the number of transactions they're processing, and then they are paying 0.11 the gross payment volume processed by Flutterwave, and 0.19 the gross payment volume. The important thing to note here is that the multiple of gross payment volume is increasing, which means people are paying more. The value is going up of the business. And then you can see here, based on the number of businesses, the multiple as well. So this is the kind of exercise that Digest Africa is starting to do for each transaction out there. It would be helpful if startups in Africa could, even if they anonymize the information, you can tell us, have you raised a funding round recently? Which sector are you? How much was your round? What was your revenue at the time? Therefore, you can know what multiple guys paid. And then you don't have to say what the name of your company is. That information is collected anonymously, and then that is made available to help with mapping valuations in our markets. And then investors and starter and entrepreneurs can all know this, and then you have a basis when you start the negotiation. Because these multiples can change over time depending on whether you're in an upturn or a downturn in an economy, in a cycle. But yeah, these are maybe I don't know if that's answering your question, William. But these are the kind of, someone has to go and find that information.
Sure. Thanks.
And hopefully get paid. Imagine I'm doing this here, but no one paid for this, you know.
Of course.
But yeah, there's work being done. Yeah.
We have a question from Alex, and I think this has to be the last one.
What is the criterion of dividing equity to the co-founders of product or startup, which is still a child, not a... Yes, good question, Alex. Yeah, that one is subject to you guys agreeing. Usually, it will be dependent on the roles you're all going to play as co-founders in the startup. And usually, you'll sign what is called a co-founder collaboration agreement. And in there, you list your roles. And therefore, in exchange for those roles, what you think is acceptable and equitable. That those roles, you could quantify them based on time and what an equivalent salary would be, and then divvy it up and see what proportion it is. That can be a technical, scientific way of doing it. But sometimes it might be that, I don't know, the two co-founders just mutually agree they'll take 60-40 of the company. And then as they get diluted, they know they are diluted in that ratio. If you need to allow for employees, if you need to allow for unallotted shares, but you should be at that point as founders where you have these frank discussions about these things. But a technical way would be you list what each of you is going to do, you quantify it and value it, and then split the equity on that basis, maybe. And the important thing I'd advise is to make sure that equity vests. So people should not earn all that equity right at the start. So it must be earned over maybe 3-4 years, because sometimes you start and then 1 year down the road, people leave and yet you've already given them equity. And that makes it messy when you need to raise money down the road.
And somebody said, refer to Founder's Dilemma book, which explains that really, really well.
William, what does it say in the book?
I guess we'll have to read and find out. We are short of time, so please join me all in thanking Kenneth so much. I feel like we need a part 2 of this. I definitely need to go back and revise. Kenneth, thank you so much for giving up your time to share all this knowledge and expertise with us. I've definitely left wiser, both for myself as an entrepreneur and also as somebody that works within the ecosystem supporting entrepreneurs. I've definitely taken away a lot that I can share and implement. Just to let everybody know, in the next 5 minutes, we're going to ask you a favor. So I think, like you saw from the presentation, all of these sessions we get amazing speakers like Kenneth. They're absolutely free. The one thing we ask for you is to take 5 minutes to fill out our evaluation form. The evaluation form is really important for us to know that the sessions we're running are impactful, they're useful, and it really just goes to show also to our funders and supporters that that the work we are doing is meaningful. So this is my one ask from you. I'll ask my colleague Patience to share the link to the evaluation form in the chat. We have one for you as well, Kenneth, as a speaker, which Patience will share in the DMs with you. Sometimes I usually have Gideon on the call, who I always turn into my resident DJ to give us some background music as we fill out the forms. But before that, actually, there's one more thing. One of my colleagues I'll get in trouble if we don't do, but we always do a family photo at the end. So we'll ask anyone and everyone who can turn on their cameras. At this point, maybe Kenneth, if you can stop sharing the screen so we can get the full thing. So we'll do the family photo and then we'll fill out the slides. Gideon, I see you around. We need some background music for when we're filling out the form. Anyone else, any more cameras going to come on? Any more cameras? Nice to see you, William. Nice to see you, Dr. Charlie, Josephine, Alvin. It's really nice to see your faces. Patience. Anyone who can turn on, and then Georgina, let us know when you're ready.
Yes, of course, I'm ready. So please smile. Thank you so much. Thank you. It was great.
Yeah. So we'll hang out for the next 5 minutes as we complete our respective forms and listen to maybe some Afrobeats, maybe classical. We'll see what the DJ has for us. And as you finish your form, just type in the chat, done. So I know that that's done and submitted, and I will sort of, say a final thank you and goodbye. Kenneth has shared his LinkedIn in the chat for us to connect with him. So Kenneth, thank you so much once again.
No, it was my pleasure. So I know, Eunice, I forgot to mention this. You said there were hubs on the call. I just wanted to make a shout out. We invest at Angel and pre-seed stage, and we source this deal flow usually from hubs that may be mentoring some companies, and they need that fast check, maybe anywhere under $50K. So if there's any hubs in all over the continent, Zambia, Kenya, Ghana, Nigeria, any country really in Africa, and you have companies that are looking for investors, fast institutional investors who act as sort of co-founders, please feel free to reach out either on LinkedIn or on my contact details, which will be in presentation, so we can do some things together and think through if as hubs, maybe you want to be investing in companies as well, we can have that discussion. So, but thank you all for listening to me today. It's been a pleasure.
Great. And maybe, I don't know if it's useful, Gideon, but I can put you directly in touch because Gideon is our partner from Ghana, is involved with the Ghana Hubs Network. So there might be a discussion there on, particularly on supporting hubs to also take equity and invest in startups. I think that's something that we'd previously discussed. So I can definitely put the two of you directly in touch if that's okay, Gideon.
No, I look forward to meeting and connecting with Gideon.
All right. Thank you. Please, I'm waiting for the done confirmations for our, can you share the link again, Patience? So it's like the last sort of thing we have on there as well. I think my DJ has disappeared actually.
You're going to have to do your own music.
Let me see if I can.
Writing a resume is not easy.
There we go.